Hold up, you're not gonna believe what just went down in the silver market. I'm talking about the biggest freaking heist you've never heard about. A straight-up bank war that's happening right under everyone's nose. While you were chilling on New Year's, the big dogs were literally draining the vaults dry. We're talking 17 million ounces of silver, gone in 48 hours. That's insane, right? And here's the kicker. Nobody's talking about it. The news? Silent? CNBC? Crickets. But I've got the receipts, and what I'm about to show you is gonna blow your mind. Alright, let's get into it. I've got the CME Group delivery report right here, and man, these numbers are wild. The exchange issued 1,168 delivery notices. That's 5.84 million ounces of silver in one session. But zoom out for a second. In just 48 hours, the first 2 days of 2026, we're looking at 3,446 contracts standing for delivery. Multiply that by 5,000 ounces per contract. Boom, 17.23 million ounces of physical silver moved in 2 days flat. Now let me put this in perspective real quick. The entire global mining industry produces about 800 million ounces per year. So in the first 2 days of the year, before most traders even got back from vacation, the Comex was forced to cough up 2% of the entire annual global production. This isn't some commercial hedging play. This isn't factory ordering. A factory doesn't order 17 million ounces on a Friday afternoon. This is a full-blown run on the bank. You gotta ask yourself, why now? Why January 2nd? Because as of this week, China's export ban went live. New regulations in Beijing have restricted silver exports to only 44 licensed firms. This effectively cuts the supply of swing metal from the east to zero. The sharks in New York know this. They know that the 39 million ounces sitting in the registered vaults are the last easy ounces left on planet Earth. Once those ounces are gone, there's no backstop. So the Western banks didn't wait. They smashed that buy button and demanded 17 million ounces instantly. They stripped nearly half the available liquidity in 2 days. If this pace continues for another week, the Comex breaks. Mathematically, it can't survive another 10 days of this pressure without defaulting or changing the rules. We're watching an inventory liquidation event disguised as a trading session. Here's where it gets crazy. This isn't just some market move. It's a war between the banks themselves. For years, we assumed the banks were one big cartel, working together to keep prices down. But when there are only a few lifeboats left on a sinking ship, the biggest guy throws the smaller guy overboard. We're watching JP Morgan and Citigroup literally throw Deutsche Bank overboard. Let's look at who lost the medal. The primary issuer, the one forced to deliver, was Deutsche Bank. They delivered over 3 million ounces of silver in a single day. Deutsche Bank has been the sick man of Europe for a decade. Their balance sheet is fragile, and the other sharks smelled blood. Now check out who took the medal. The stoppers, the entities that demanded physical delivery, Citigroup and the king of the silver market, JP Morgan. Combined, these two grabbed over 4.4 million ounces. This is straight up a raid. JP Morgan didn't buy that silver to hedge a position. They already hold the largest physical stockpile in the world. They bought it to corner the market. This is what happens when a currency system fractures. The thieves stop stealing from the public and start stealing from each other. The gentleman's agreement that suppressed silver for 40 years is over. There are no gentlemen left on Wall Street, only predators and prey. And the prey is currently bleeding out on the exchange floor. Now let's talk about what this means for you and me. While JP Morgan was securing millions of ounces, what could regular people buy? Nothing. I've been monitoring the big online dealers, SD Bullion, Kitco, Apmex, and the data confirms the retail supply chain has suffered catastrophic failure. SD Bullion, one of the largest dealers in America, their American Silver Eagle page says, out of stock. Estimated next shipment, March. We're in early January, That's 8 weeks away. Why? Because the U.S. Mint can't the silver blanks. And why can't the U.S. Mint get them? Because J.P. Morgan just bought all the silver bars the Mint uses. Kitco? Same story. You don't even get a price, just a grayed out box that says unavailable. They're not even taking back orders. When a dealer refuses to take your money for future delivery, it means they're terrified they won't be able to source the metal at any price. And APMEX? They've got some eagles in stock, but look at the price, $89.70. The Comex spot price is $71. That's an $18 premium, a 25% surcharge, just to get your hands on the metal. This is the bifurcation in its rawest form. J.P. Morgan pays $71 because they buy 4 million ounces. You pay $89 because you buy 1 ounce. Even generic rounds have jumped from $2 premiums to $8 overnight. Junk silver, those old pre-1964 dimes and quarters, trading at 40% over melt value. There's no cheap silver left. But silver's a global market, right? Surely we can import more. Let's go to Shanghai. We just got the inventory numbers from the Shanghai Futures Exchange. They lost 46 tons of silver in a single trading session. That's roughly 1.5 million ounces. This was the very first day the new export ban went live. The Chinese industrial buyers, the solar manufacturers, the EV plants, they're panicking. They're looting their own exchange because they know no new metal is coming in from abroad, and they can't get metal out easily. They're trapped. At a depletion rate of 46 tons a day, the Shanghai exchange goes dry in 14 days. 2 weeks, that's the timeline. Look at the global picture. New York is bleeding 2.8 million ounces a day. Shanghai is bleeding 1.5 million ounces a day. That's nearly 4.5 million ounces vanishing every single day. The global mining industry only produces about 2 million ounces a day. We're running a daily deficit of 2.5 million ounces. The world is consuming more than twice what it produces. The math is broken. And here's a technical term that sounds boring, but is actually huge: backwardation. In a normal market, the future price of silver is higher than the spot price. But right now in China, spot price is trading higher than the future price. Why? Because factories are screaming, "Don't promise me metal in February. I don't believe you. Give me the metal today." This backwardation is the heartbeat of a squeeze. It happened in palladium before it went to $3,000. It happened in rhodium before it went to $29,000. Now it's happening in silver. So here's the question flooding my inbox. Is J.P. Morgan bankrupt? Did this raid break the banks? Let's do the math. J.P. Morgan and Citigroup took delivery of 4.42 million ounces at $71 per ounce. That's roughly $314 million total. Now, J.P. Morgan currently holds $1.65 trillion in Tier 1 capital. Citigroup holds about $240 billion. So $314 million represents 0.02% of their combined safety buffer. Let me repeat that, 0.02%. It's the financial equivalent of buying a cup of coffee. It doesn't dent their balance sheet, doesn't threaten their solvency. But here's the critical part. If the cost was so small, why did they do it? Why did they break the unspoken truce with Deutsche Bank? Because while they have infinite dollars, they know there's finite silver. They raided the market today, not because they had to spend the money, but because they had to secure the metal. They know that next week that same $300 million might only buy them 2 million ounces, and next month it might buy them nothing. This proves the crisis isn't about solvency, it's about availability. It's a physical lockout. The banks are converting their worthless paper fiat into the only asset that China, Samsung, and Tesla are fighting over. They're front-running the inevitable revaluation. For 40 years, the banks suppressed the price. But why? To accumulate. You suppress the price while you're buying. But once you're full, Once you've drained the vault and secured the supply, you have no incentive to keep the price down. In fact, you have every incentive to let it rip. If JP Morgan now holds hundreds of millions of ounces of physical silver, and they've closed their short positions, do they want silver at $71 or at $200? They want it at $200. This is the pivot. We're likely to see the banks stop fighting the trend and start fueling it. When you see the price rise, don't think the banks are going to smash it. Think the banks are pushing it. When Asian markets open Sunday night, what do you think China's going to do when they see this delivery report? They'll see JP Morgan took 4 million ounces. They'll see New York is draining, and they'll interpret this as an active resource war. This will trigger a panic in Shanghai. I expect a violent open. We could see a gap up as Shanghai traders try to front-run the New York Open. Here's the bottom line. You're holding physical silver. JP Morgan is holding physical silver. You're now allies. You're on the same side of the trade. But as the price rises to $80, $90, the banks will launch marketing campaigns. Sell us your gold and silver. High prices, cash out now. They'll try to convince you to trade your hard asset for their paper. Don't do it. They're buying because they know the fiat is dying. The premiums at Apmex, $89. That's the real price. Don't sell for less than the street price. Actually, don't sell at all until the gold to silver ratio tells you it's time. We're nowhere near that time. Here's the verdict on the 17 million ounce raid. It was a heist. It was the day the big banks realized the game was up. They stopped pretending the market was liquid. They took the metal and ran. The vaults are empty. The retailers are sold out. The East is hoarding, the West is raiding, and the price is sitting at $72 for now. This is the calm before the revaluation. You have the data. You have the map. Now all you need is the patience. The metal is gone. The squeeze is here. Welcome to the new world.